Okay, fantastic, amazing. Let us go to the next series of questions. The next series of questions are the insurances. So let's go one at a time. Jill's question is, my husband and I are both feds. Ooh, 2 federal employees, what I call the untouchables. We are both over 50 with at least 20 years of service. My husband carries and always has the FEHB plan for our family. If I take the VERA and retire, and then later my husband gets converted to Schedule F and fired, can I take over FEHB? To answer your question, Jill, yes, you can. That is, if your husband gets fired and he loses his FEHB coverage, that is considered a qualifying event where you could adjust your health insurance plan. Just so you know, qualifying events, one of the qualifying events is if you have a dependent and loses coverage. So then you could adjust, or if you yourself lose FEHB coverage because your spouse was the plan and they lost their FEHB coverage, that is a qualifying event for you to pick up FEHB on your own. Now, you may say, Jill, you may say that I already retired. Can I pick up FEHB in retirement if my husband loses his FEHB due to a Schedule F firing? And the answer is yes. Even in retirement, that is considered a qualifying event for you to pick up. And as long as you had FEHB for the 5 years before you separated, which, Jill, it sounds like from your question, you're going to have FEHB. It's not going to be your own FEHB. You're going to be under your husband's FEHB. But believe it or not, being under your husband's FEHB counts towards your 5-year requirement. Okay, so Jill, you've satisfied the 5-year requirement by being under your husband's plan. If your husband gets fired, then that is a qualifying event for you to pick up your own FEHB. Next, Dan and Greg have similar questions. Dan's question is, how much life insurance should a retiree carry into retirement, and how should you pay for it, whether it's FEGLI or private? Greg's question is, can you talk about first annuities, specifically considerations for no survivor benefit versus the 50% or the 25% survivor benefit? I will be retiring under VERA no later than December 31st, and I need to figure out what is the best for my spouse. Okay, so Dan and Greg, okay, let me tell you what most of my clients do. Most of my clients, they choose the 25% survivor option. However, with that being said, I got that out of the way. Now that I said most of my clients choose the 25% survivor option, let me just be very clear about something. When they choose whatever they choose, it's not because they guessed. You don't guess on these things. You don't guess on early death scenarios. You don't guess on whether your spouse could survive when you pass away financially. You test and you measure your ability to do. This is exactly what the financial planning process does. This is definitely what is done, what I do for my clients. Okay, so this is like ABCs of financial planning. Okay, so with that being said, you got to test. And when I test, I find most of my clients end up choosing the 25% survivor option. However, let me be very clear about something. There are many clients that I tell to leave zero, nothing, no survivor benefit, no FEGLI, okay, nothing. But then I also have some clients where I tell them to leave the maximum, okay? So really, let me flip the question on you guys. Do you even need life insurance? That's really the question. Do you even need life insurance? And the answer is, for most people, yes, they could benefit from the 25% survivor option. However, there are a chunk of people that don't need any life insurance, and there's some people who need the maximum life insurance. Let me give you an example of somebody who I said should leave the maximum survivor benefit, and also the maximum FEGLI. Okay, I'll give you a great example. So one of my clients this year, unfortunately, was diagnosed with a terminal illness. So they don't really have much of a life expectancy. Now, it happens to be this client and their spouse, they have plenty of money. They have plenty of assets. Like, money's not an issue for them. But even with that being said, even with money not being an issue, I'm telling this client to leave the maximum survivor benefit, the maximum FEGLI. Why would I do that? The reason is obvious. This person only has a few more years left to live. That means they're only going to be paying a little bit towards their survivor benefits and a little bit towards their FEGLI life insurance. And then they pass away and they leave their survivors a huge benefit. So the benefit that their survivors get relative to what they have to pay, that is a fantastic rate of return. By the way, if you understand what I just did, I basically just converted this life insurance conversation into a rate of return conversation. Only a sick, twisted financial advisor could do such a thing. But that's what I do. I'm basically looking at your premiums as an investment and what is going to be the return on that investment. So if somebody has a very short life expectancy, I'm going to tell them to max out on their survivor benefits. And I'm also going to tell them to max on their FEGLI in that situation. Okay. Let me give you a situation where I actually tell my clients to max their survivor, but don't do the FEGLI. Isn't that interesting? There's a situation where I tell them to do the max survivor, but not the FEGLI. It's very, very simple, actually. So I have a number of clients in this. Let's say you have a husband and a wife. The husband's a federal employee. The wife is not a federal employee. And the husband is many years older than his wife. Now, statistically speaking, I'm sure you guys know this. Guys don't live as long as the girls. Okay, guys die first. Okay, guys, I'm just letting you guys know. Okay, guys, they have the privilege of dying first. So if I'm dealing with a guy who is significantly older than his spouse, that means that his spouse, who's a girl, is very likely to outlive him. By the way, if they were the same age, the female would likely outlive her male husband. So that's if they're the same age. If the guy is much older and she's much younger, so then she is certainly going to outlive her husband. And not only will she outlive him, but she will probably get back not just all the money he paid into that survivor benefit, but even a nice rate of return on top of that money. Once again, the rate of return compensation. So that's a situation where I'm not going to tell them to do the FEGLI, but I am going to tell them to do the maximum survivor benefit. So if there's anybody in this room that is, let's say, a male federal employee, and he has a wife, and the wife is significantly younger. When I say significantly, it's usually 6+ years younger. So the husband's 6+ years older than the wife. In that case, I tell them to choose the maximum survivor. However, on the flip side, there are situations where I tell them to do zero survivor. Zero survivor. I'll give you an obvious example. Let's say you have a federal employee, and the federal employee's spouse is the one with the terminal illness. So that means that spouse is very likely going to pass away in the near future. Why should the federal employee pay for life insurance and survivor benefits to leave something for their spouse, who the spouse anyhow has a very short life expectancy? Very likely the spouse is going to pass away before them. In that situation, I actually say you don't need any life insurance. Okay? So I hope I'm making sense on you, but Dan and Greg, with any of the scenarios, you don't guess on these things, you measure. Sean is asking a question on the bottom of the slide. How does portability work with our government life insurance? And if you quit and you want to take it with you, I understand I have to pay the premiums, but do you know how inexpensive they truly do that? Okay, so Sean, just if you quit federal service, you are able to have a temporary continuation of your life insurance for, I want to say, 31 days. 31 days. And during that period of time, if you want to continue, you actually have to apply for a continuation of your FEGLI life insurance coverage. You're basically going to apply to have your FEGLI coverage converted from a group term policy to a personal whole life policy. And I don't know if you guys know, whole life policies are relatively expensive. They're going to be more expensive than a term policy. What's nice is that there's no underwriting. If you do that, there's no underwriting on that conversion. Okay, so that's very nice. But for those who have been to my class, you may know my attitude when it comes to whole life insurance. Whole life insurance is basically an instrument where you put money into the instrument, over time it grows, and in the future it's worth more money. And when you pass away, they give that money to your survivors. Now, is anybody detecting what I'm trying to describe? What I'm trying to describe is that you're putting your money into the instrument, and over time it grows, and in the future it's worth more money. Doesn't that remind you of anything? It reminds me of your TSB. You put money into it, over time it grows, in the future it's worth more. So basically, a whole life policy is a form of investment instrument. Once it's a form of investment instrument, I try to look at the rate of return. And if you look at the rate of return on a whole life policy, usually it's a very modest rate of return. The guarantees are usually about 4% growth rate, but even the 4% growth rate, the internal rate of return is usually less than 4%. Okay, again, I'm not going to get into those details, but you can look into it on your own. The internal rate of return on a whole life policy is usually under 4%, as opposed to your TSB, which, it depends on what you're investing in. But had you invested in the C fund, I'm just pointing out the C fund for the past half a century has yielded over 10%, which is obviously better than the 4%. And at the end of the day, they're just going to cut a check to your survivors using your money, which basically means You are the insurance company that is backing your policy. That is self-insurance. So when it comes to whole life policies, I'm not a big fan. All right. There's always exceptions. There's always places for these types of things. But for the vast majority of federal employees, the whole life is not really the strategy that's not the strategy of choice.